Now we get to pivot to the U.S. and do we expect to happen at the Fed funds, at the Fed meeting, or what they're going to announce on March 22nd, I believe is when we get the announcement. And right now, the market is pricing in essentially a 50% chance of a 50 basis point hike. So it's a coin toss. I think that there is a very good chance we get a 50 basis point hike. My base case was 25 basis points, but I have since increased that to the 50 side, just because there's things have accelerated in different periods. We had January coming in fairly hot. We had February coming in, so far pretty above expectations, and that's going to, I think, prompt something additional, which is why when I showed the Nomura chart, I think it was either last week or the week before, they have a 50 basis point hike followed by 2 25 basis point hikes. And I think that that's a fairly stable view. And this is just taking a point in time yesterday when you look at the 2-year. The 2-year surged to new highs. We have one of the biggest inversions in our history, and that's including what happened in the early 80s. And this is just looking at it from the 3-month versus the 10-year. This is the biggest inversion we've had going back to 1993. And you're getting an idea on just the level of the problems and what is being priced into the market. And the bond market is sending a very clear signal that the equity market still isn't really looking at. But at the same time, the view is that the equity market is saying, okay, well, look at bonds. Bonds are really bad. Therefore, the Fed's going to have to yield. But then the Fed's looking there and saying, well, looking at inflation, looking at jobs, we're not really going to pivot. And that's why each time the bond market gets worse, but yet the equities it's almost like they're sitting there saying, oh, no, well, because bonds have gotten worse, therefore the Fed's going to pivot. And it's like, there's just this circular view, which is this catch-22, which continues to just be this cycle because, again, we do see a lot of pressure. We see more pressure coming, and we do see a lot of downside in the equity market. And that's where realistically we see additional movements by the Fed trying to, I think, bring this under control. And then on the other side, you could say, well, why should the equity markets go down at this point, given the amount of liquidity that still exists in the market? Yes. Is M2 negative? Yes. They're finally starting to take some liquidity out, but there's still over $2 trillion in the ORP. There's still a significant amount of liquidity that remains in the market, which is why they're going to have to stay at a negative M2 for such an extended period of time. And that's going to be a problem. That's going to drive problems in the near term, but we need to purge the system to get back into some sort of normalcy, which is why to see the implied terminal rate is now up to 5.63%. Again, where we think it sits is that 5.75 is likely where we're going to go. And you can see here that the 50 basis point hike in March went from 50% of a coin toss to a 65% chance of a 50 basis point hike in March, which is coming up in a week or two. And there's a lot of data that's going to come out. We're going to get CPI before that. We're going to get some of these key landmark numbers, but we don't see any real way that they're going to come in at a point that is going to show bigger deflation and a reason not to do 50. And that's the problem that we're seeing. Like even the jobs data that we're going to go through in this section and segment in the next, there's nothing there that says that the market is coming into balance and that they can either slow and or stop hikes. It's still going to be steady as it goes. JOLTS quit rates moved down in January to 2.5%, which is still elevated relative to history, but lowest since March 2021. JOLTS hires rate edged up to 4.1% in January, down from 4.3% a year ago. So again, you're still seeing very elevated numbers. They're starting to normalize. They're starting to come down. But again, it's still taking time for this to come through because we still have a very low participation rate. We still have elevated amount of retirements, which is keeping things fairly tight. which is why we're still seeing wages remain elevated. We're still seeing some of these numbers that are coming down, but still well above normal. Now, when we start looking at job cuts, job cuts have accelerated, and it's no longer just the technology sector that is seeing it, but it takes time for this data to really catch up with itself. And there is a certain amount of error factors that come into it because of the lack of responses they're getting from surveys, the problems. So, could it be worse than what we're seeing? Yes. Could it be better? Maybe. Maybe it's not coming down as fast. It's somewhere in the middle where we're getting some of these movements and because we do have higher rates, that is going to create a change in the way companies are going to deploy CapEx, the way they're going to hire. But again, it takes time for this to move down the system, which is why, if you look at the Taylor rule, which says we should be at 10.7% on the Fed funds rate level, or other metrics that say we should be closer to 8%, we're not getting there. If we get to 6%, that's the top of the range. Maybe it goes higher. Right now I would say 6% is the highest we could possibly go. But because there's still that delta between where we quote unquote should be and where we will be, is going to give them the ability to just stay firm. And I think that's something that has to get priced into the market, that we're still seeing some holdouts on, which will adjust some of those views. So the January JOLTS job openings, as you can see here, came in at 10.82 million versus 10.55. The estimate was for 11.23. So again, you're seeing some of the, and then 11.23 in the prior month. So it came in above estimates. Realistically, it had got revised up. So it's still elevated. There's again, from a jobs perspective, there's no pivot coming. Like, they're still showing you there's going to be something, there's some softness starting, but starting and being where we need to be are very different, which is why they're still going to move this up. There is a delay between Fed funds and when it flows through the system. But at the same time, if you look in the 70s, they also stopped too soon and they started cutting too soon, which then resulted in much worse inflation, and that created that wage price spiral that had to be broken by Volcker. Now, the revolving credit growth went to 15.6% year on year in Jan, near the highest rate since the mid-1990s when you look at it on a year-over-year basis. So you just look at a very large number. So when you look at some of the numbers in general, so total card spending per the credit card data, spending levels average from Jan 21st to 28th of the same year last year, you can see that there's been, things have slowed down a bit in Feb. When you look at February, we have cooled off as we've gotten to the back half of the month, which is very consistent with what we've seen, where people had that sticker shock that we've talked about, where they went out to dinner in January or maybe early February, and they're like, wait, how much does this cost? Like, is this menu correct? Did you make an error here? Like, this is a price that and again, that is something that it takes time to filter down, and you're now starting to see that. But at what point does the Fed start to get more aggressive on the asset-based side? Because as we showed last week, asset prices are still insanely high. They flatlined, but they're still far and away above where they've ever been versus wages. So when you look at some of the data sets on just living expense, living costs are going higher, people are starting to pull back. At some point, that asset price has to crack and come down. And again, selling down MBS or mortgage-backed securities would accelerate that and bring things quicker. It would be painful, but again, pain that has to happen to purge the system and create something that we can, a foundation or framework that we can then enter the new bull market and start to grow again. But again, the longer this gets prolonged, which I think, for those that know me, I've been saying that's my base case, where this is going to be prolonged. Instead of getting some, a big shot to the downside, it's going to be bumping along the bottom, negative 5%, negative 0.5% growth, negative 1% growth, and then just bouncing around at those levels. So then when you look at wholesale inventory sales ratio starting to turn lower again after seeing a rapid rise over the past year, change in imports starting to turn higher, percent change edged up slightly to 3.5% in January, an acceleration from the 1.6%. But then we saw a drop down in Feb, and now we're starting to see a little bit of a pickup in March. So it's more along the lines that we're balancing out here. We're not going to continue to crash lower, but there's really no reason to move up or down. Historically speaking, we're on the lower end, but given spending, given where the economy sits and where manufacturing is, there's really no impetus to go out and buy more stuff. And that's when you start looking at the inventory sales ratio. It's starting to kind of balance out, and it's just inventories have been moving up. Sales have been, come down a bit, still elevated, but against inventory, there's now more inventory to work through, which is also going to keep those imports compressed. Cumulative fiscal tightening from COVID emergency-linked programs continues to pull back. That's something that is going to become a bigger issue when we look forward, as we look at some of this tightening, because a lot of this goes into what's the good quote? If a U.S. consumer gets $1, they spend $3. So as some of this stimulus comes out, well, all of this money was already spent. It's not going to be spent again. And then that service inflation overshoot is most worrying in multiple areas, because it's not just the U.S. You're seeing it in other places as well. And the biggest issue is in the CEE area and Latin America, where you're seeing a lot of these pressure points, but U.S. isn't far behind when you look at where the U.S. is in Latin America, which is why these rates are going to continue to go up to try to get in front of that. And it's not just the U.S. that's going to see it. We're going to see a continuation of this, because inflation is not just a U.S. problem, as we talked about in the first segment, and those pressure points. Then when we look at U.S. corporate profitability expected to slow in the coming months, which is obviously expected, but then look at the retail average net equity buying. The U.S. retail investor has been a net buyer significantly throughout this first quarter for the most part. So, when you look at the underlying backdrop, we have to put this into perspective. So the U.S. now has a record $6.5 trillion in household debt, a record $11.9 trillion in mortgage debt, a record $1.6 trillion in auto loans, a record $986 billion in credit card debt. So total mortgage debt is now more than double the 2006 peak. The cost to maintain it is lower because rates were lower, but again, that's still a meaningful number. Meanwhile, 36% of Americans have more credit card debt than savings, with balances rising at the fastest pace since 1999. All while mortgage rates just hit 7.1% and credit card debt rates hit a record 24.9%. So and the quote was, they're fighting inflation with debt, which ends terribly. And at some point in the very near future, we think retail is going to, again, see this, look at rates, look at their exposure, and then look at their bank account, look at their balance sheet, and they're going to start pulling some of this equity out or reducing their equity exposure, especially when you look at profitability and additional pressures to the downside. Now, when you look at the trend on corporate earning calls, they've been focusing a lot on free cash flow to equity margin, reshoring, but we want to hone in on free cash flow and reshoring. That is that reshoring, onshoring, the same nomenclature. That's the focus, is adjusting where you're manufacturing. And that is what we've been talking about. That is going to be inflationary in its own right, because it's going to be more costly to do it. It's again, I'm not saying that it's inflationary, like, oh, it's inflationary, they shouldn't do it. I'm saying they should have done it, 10 years ago, 8 years ago, but they're doing it now, and it's always going to be inflationary, but long term, it's a good way to help diversify supply chains and create some continuity. But you're going to try to balance that with free cash flow while trying to maintain margin, while building new facilities where prices are still elevated, is going to be very difficult to manage, which is something that we've been highlighting for some time. And all the while, some banks need more funding. And this is something that we've been talking about, especially on the small bank side, The very biggest banks can afford to slow walk their rate increases, again, thinking about savings, simply because they still have relatively high deposit levels. Overall, the average rate on a 1-year CD is roughly 1.5%. That's up from 0.25% a week before the Fed began raising rates, but it's still well below inflation. After a year of record profits, the foot dragging has earned banks plenty of problems from the politicians. But banks are starting to feel that pressure to be more competitive, and that's going to increase because small banks are underfunded, which is something that we've been talking about. Small banks are a problem and are going to continue to be a problem, which is something that has to be addressed in general. So that's where we continue to see some problems and why we've talked so much about small banks, because that's where the issues are going to reside. They've had to increase their bad debt expense. So then their ability to go issue new debt at higher interest rates to cover higher savings expenses is going to be difficult. And again, more problems in general ahead. So that's what we have for you on this side of the equation. In the next side, we're going to go deeper into the service inflation, service activity, as well as a bit on the housing front.